Ever stared at a page filled with capital T's and wondered what secret language accountants were using? You're not alone. My financial literacy journey started with a healthy dose of confusion around these mysterious T accounts. Debit this, they'd say, credit that. It all felt like an ancient accounting ritual, shrouded in complexity and a bit intimidating. But fear not, this guide is here to change that. Today, we're going to break down T accounts into bite-sized pieces, explain why they're important, spoiler alert, they're like the building blocks of accounting, and show you how to use them like a pro. Ready? Fantastic. So, what are T accounts and why are they important? T accounts are a fundamental concept in accounting, serving as the bread and butter of financial record keeping. Picture this, you're drawing a giant T on a sheet of paper. That's your T account right there. The top of the T is where you write the account's name, like cash or revenue. Now, the left side of the T is for debits, and the right side is for credits. It's a visual way to see how transactions affect different accounts. In double entry bookkeeping, every financial transaction impacts at least two accounts. One gets a debit entry, and the other gets a credit entry. This system ensures that the books balance, with every action having an equal and opposite reaction, so to speak. The T account helps you visualize this balance. When you debit an account, you either increase an asset or expense or decrease a liability, revenue, or equity. And credits do the opposite. Let's say you buy a coffee machine for your office. You debit the equipment account because you've gained a new asset. At the same time, you credit the cash account because you've spent money. This dual recording reflects the economic exchange that's just taken place. Now, why are T accounts so important? Well, for 5 key reasons. First, they help you understand double entry bookkeeping, which is the gold standard in the accounting world. This system ensures that every financial transaction has two equal and opposite entries. One side of the transaction goes on the debit side of a T account, and the other goes on the credit side of a different T account. This creates a self-balancing system where the total debits always equal the total credits, minimizing errors and ensuring the accuracy of your financial records. Second, T accounts provide a visual aid that can make a world of difference. Let's face it, financial statements can be dense and confusing. With their simple T shape and clear separation of debits and credits, T accounts allow you to see the impact of each transaction on specific accounts, making it easier to track the flow of money throughout your business. Third, they are a fantastic learning tool for beginners. If you're new to accounting, T accounts provide a practical and hands-on way to learn the basics of debits and credits and how these concepts translate into real-world financial transactions. By working with T accounts, you can build a solid foundation for understanding more complex accounting principles. Fourth, T accounts are not just for beginners. They can also be a valuable tool for experienced accountants who need to analyze complex transactions. By breaking down a transaction into its debit and credit components and recording them in separate T accounts, you can better understand how it affects your financial position. Finally, T accounts can help you catch errors in your bookkeeping. Any inconsistencies will quickly become apparent because they rely on the double entry system, where debits and credits must always balance. If your T accounts aren't balancing, it's a red flag that there's a mistake somewhere in your records. Now, let's dive deeper into understanding debits and credits in T accounts. Debits and credits can be tricky initially, but they're the foundation of understanding how businesses track their finances. Here's where T accounts come in. They're like little filing cabinets for your financial information, with a fancy T shape that helps visualize debits and credits. The left side is the debit side, and the right side is the credit side. But what goes where can depend on the type of account you're dealing with. Let's break it down. First, we have assets. These are the things your business owns, like cash, inventory, equipment, and buildings. Debits here make sense because they represent adding value, like buying new equipment which increases the total value of your assets. Conversely, credits mean you're selling something and reducing the total asset value. Next up, we have liabilities. These are your business's debts, money owed to others. Debits might seem counterintuitive here, but remember, they represent resources coming into your business. So, when you borrow money from the bank, you're also increasing your liabilities. Credits mean you're paying off a debt, which reduces what you owe, making sense why it decreases the liability balance. Then there's equity. This is the owner's claim on the business, basically, what's left after you subtract liabilities from assets. Debits here might surprise you, they reduce equity. This happens when you pay dividends to yourself, which takes money out of the business and reduces your ownership stake. Credits, on the other hand, increase equity. This could be from investing your own money in the business. Now, let's talk about revenue. This is the income your business earns from selling goods or services. It might seem strange that debits decrease revenue, but this follows the seesaw principle. When you earn revenue, you're also using up your ability to earn that income again. Credits increase revenue because you're recording income on account, which hasn't been collected as cash yet but still represents income earned. Finally, we have expenses. These are the costs incurred to run your business, like rent, salaries, and supplies. Debits make sense here because they represent spending money, which decreases your available value. On the other hand, credits would reduce expenses. This could happen if you return supplies to a vendor and get a credit. Understanding debits and credits can take some practice, but with these explanations, you'll get the hang of it. Now that we've set the stage for understanding T accounts, let's dive into a step-by-step guide on how to use them for transactions. T accounts might initially seem intimidating, but with a structured approach, you'll be a T account pro in no time. Here's a breakdown of 7 steps to master using T accounts for transactions. First, grab your pen and paper. The beauty of T accounts is their flexibility. Draw a simple T shape for each account you'll be using. Write the account title neatly at the top, like cash or inventory. This T becomes your battleground for recording financial transactions. The left side is for debits, and the right side is for credits. Second, understand the debit and credit lingo. These terms might sound fancy, but they're actually quite straightforward. Debits represent increases in assets and expenses, and decreases in liabilities and equity. Conversely, credits show increases in liabilities and equity, and decreases in assets and expenses. Third, identify the transaction type. Every transaction has 2 sides to the story. Let's say you buy office supplies for $50 in cash. This purchase increases your supplies, but also decreases your cash. Here, we're dealing with an exchange of assets. Identifying the type of transaction is crucial for accurate recording. Fourth, analyze the account impacts. Let's dissect our office supply purchase using T accounts. On the left side of the supplies T account, we record $50 because our supply inventory has increased. On the other hand, for the cash T account, since cash is decreasing, we put $50 on the right side. This ensures our T accounts maintain balance. Fifth, practice makes perfect. The more you use T accounts, the more comfortable you'll become. Here's another scenario. You receive $100 from a customer for their service. In the cash T account, we debit $100 because our cash has increased. With a service revenue T account, we credit $100 because revenue increases with credits. See how it works. 6. Remember the golden rule, debits equal credits, always. This is the magic formula of double entry bookkeeping. Every transaction will always have a corresponding debit and credit entry with equal amounts. This ensures your accounting equation remains balanced, a fundamental principle for accurate financial records. Finally, once you master these steps, T accounts become a powerful tool for visualizing and understanding your business transactions. They help you track cash flow, analyze expenses, and ensure all your financial ducks are in a row. Don't be afraid to experiment with different scenarios. The more you practice, the more confident you'll become in managing your financial data. Now, while T accounts are incredibly useful, they do have limitations. It's important to recognize these to ensure accurate financial reporting and decision making. First, T accounts provide a simplified representation of ledger accounts, often lacking the depth needed for complex transactions. In a business scenario involving multiple accounts and numerous transactions, T accounts may fail to capture the full picture. Second, T accounts can become unwieldy and inefficient in large-scale operations, such as those of multinational corporations. Managing a multitude of T accounts for various subsidiaries can lead to confusion and errors. As the volume of transactions increases, maintaining T accounts manually becomes impractical and prone to mistakes. Third, while T accounts are manual tools, their compatibility with modern accounting software is limited. Many accounting software solutions offer sophisticated features for automating bookkeeping processes, but T accounts lack seamless integration with these advancements. Fourth, T accounts may not adequately accommodate accrual accounting principles. Accrual accounting recognizes revenue and expenses when incurred, regardless of cash flow timing. T accounts, primarily designed for cash-based transactions, may obscure the timing and matching of revenue and expenses. Fifth, T accounts offer limited analytical capabilities for decision support. In today's dynamic business environment, stakeholders demand comprehensive insights to drive strategic decisions. T accounts cannot perform sophisticated financial analysis techniques, missing valuable insights and opportunities for improvement. 6. T accounts primarily focus on current transactions, providing limited historical context. While they track changes in account balances, they do not offer comprehensive historical data or audit trails. Finally, T accounts offer limited flexibility in reporting formats. Businesses often require customized reports tailored to specific stakeholder needs, but T accounts lack the flexibility to generate such reports efficiently. Now, let's clarify the difference between T accounts and the general ledger. T accounts are nifty T-shaped tools accountants use to visually track debits and credits for specific accounts. The general ledger, however, is the big picture encompassing every financial account in your business. It's like a comprehensive filing cabinet for all your financial transactions, while T accounts zoom in on a single account. The general ledger condenses information, showing each account's ending balance, but not the whole story. T accounts capture every single debit and credit throughout a specific period, revealing the journey of that account, not just the final destination. So, if the general ledger is the ultimate record, why bother with T accounts? There are several reasons. T accounts are fantastic for beginners. They help you grasp the concept of debits and credits. They also serve as a double-checking mechanism before finalizing entries in the general ledger. T accounts allow for detailed analysis of specific accounts and help with planning and forecasting. Now, let's talk about leveraging T accounts for different users. A surprising number of people use these handy tools. For accountants and bookkeepers, T accounts are the bread and butter of their daily routine. They visually represent the flow of money through a business, ensuring accuracy in records and financial statements. Entrepreneurs and small business owners can benefit from T accounts too. They offer a clear and concise way to track finances without getting bogged down in complex spreadsheets. Personal finance enthusiasts can use T accounts to gain control of their budgets, while accounting students can use them as training wheels to bridge theoretical concepts with practical applications. Loan officers and credit analysts utilize T accounts to assess the financial health of potential borrowers, while some stock market investors use them to track their investment portfolios. Even individuals filing taxes can use T accounts to organize income and expenses, simplifying the process of gathering tax-relevant information. So, there you have it. T accounts are surprisingly versatile tools used by a diverse group of people. From accountants and entrepreneurs to students and investors, understanding T accounts empowers individuals to make informed financial decisions and confidently navigate the world of money. As we look to the future, how are T accounts evolving in this digital age? Well, gone are the days of meticulously drawing T accounts on paper. Now, interactive accounting software allows you to create and manipulate T accounts on screen. You can drag and drop transactions, visualize account balances dynamically, and link them to your general ledger. Automation is also playing a role. While T accounts aren't about to be replaced by robots, automation is tackling repetitive tasks like data entry, allowing T accounts to become even more valuable as a tool for analysis. You can use them to map out complex transactions, identify potential errors, and better understand how different accounts interact. In the digital age, accounting software can integrate with your bank accounts, providing real-time transaction data. T accounts can serve as a bridge between raw data and meaningful insights, allowing for more proactive decision-making. With automation handling the heavy lifting, accountants can shift their focus to the bigger picture. T accounts help visualize the double-entry bookkeeping system, empowering accountants to analyze financial data with greater confidence. As seasoned accountants adapt to new technologies, T accounts can serve as a bridge between their experience and the digital world. For new accounting students raised on software, T accounts provide a familiar and intuitive way to grasp the underlying logic of accounting. So, what are T accounts? They're a clear and concise framework for understanding financial transactions. As we wrap up, remember that mastering the basics is the foundation for financial success. Use T accounts to track your business transactions, analyze your budget, or even impress your friends with your accounting prowess. The future of finance might be digital, but T accounts will always hold a special place. They're a timeless tool that can simplify even the most complex financial situations. So, keep this guide handy and refer back whenever you need a financial refresh.